Have you ever wondered what it would look like if the financial system tried to warn us before it breaks? Not after the crash. Not when markets are already falling. But before everything starts to unravel. Because right now, it is warning us. Quietly. Relentlessly. In a way most people don't notice, or choose to ignore. On the surface, everything looks fine. Stock markets are climbing. Unemployment is low. Headlines talk about resilience, soft landings, and a strong economy. But beneath that calm surface, something is deeply wrong. There is a signal, a single line on a chart, that has appeared before almost every major economic collapse of the last century. Before 1929. Before the dot-com crash. Before 2008. And that signal is flashing again today. It's called the yield curve inversion. It's not loud. It doesn't make headlines. And it doesn't trigger panic overnight. But historically, it has been one of the most reliable warnings the financial system has ever produced. Every time it appeared, people said the same thing. This time is different. The economy is strong. The old rules no longer apply. And every time reality proved otherwise. What makes this moment different is not that the signal has failed. It's that the signal is stronger than ever. The current inversion is deeper. It has lasted longer. And it reflects more stress in the system than at almost any point in modern history. Yet most people look around and see no danger. That contradiction, between what the markets show on the surface and what the bond market is screaming underneath, is exactly where every major crisis begins. Because crashes don't start with panic. They start with confidence. They start when everyone believes the danger has passed, even as pressure continues to build. And pressure always demands a release. In this video we're going to break down what this signal really means. Why it has never been wrong. Why the delay we're seeing now may actually make what comes next worse, not better. And most importantly, why this isn't just about another recession, but potentially about a deeper reset of the global financial system itself. So stay with me until the end. Because understanding this signal before everyone else does can make the difference between being caught in denial and being prepared. Welcome to Finance Archives. To understand why this moment is so dangerous, we need to understand one thing clearly. What the yield curve actually is. And why an inversion is not normal, ever. Think of the yield curve as a timeline of trust. Under normal conditions, investors expect to be paid more for lending money over a longer period of time. A 10-year loan should always offer a higher return than a 3-month loan. Why? Because the future is uncertain. Time carries risk. And risk demands compensation. This is how a healthy financial system works. But an inversion flips that logic upside down. Suddenly, investors demand higher returns for lending money short-term than long-term. They would rather lock their money away for 10 years than lend it for a few months. That's not optimism. That's fear. It's the market saying, I don't trust what's coming next. And this isn't theory. It's behavior. The bond market, the most conservative, cautious part of the financial world, is where institutions go when they're afraid. Pension funds, insurance companies, central banks. They don't speculate. They don't chase hype. They move early and quietly. So when the yield curve inverts, it means something critical. The people with the most to lose are preparing for stress before everyone else sees it. That's why this signal has such a powerful track record. It doesn't predict the day of a crash. It predicts the conditions that make a crash inevitable. And here's the part most people don't understand. The danger isn't just that the curve inverts. The real danger is how deep it goes, and how long it stays there. A shallow inversion suggests a slowdown. A deep, prolonged inversion signals something far more serious. It means liquidity is tightening. Credit is becoming more expensive. And the cost of carrying debt is rising across the entire system. That pressure doesn't show up immediately. At first, nothing seems wrong. Markets keep rising. Jobs numbers stay strong. Spending continues. But behind the scenes, borrowing becomes harder. Refinancing gets more expensive. Margins shrink. And slowly, invisibly, the system starts to fracture. What we're seeing today is not a brief warning. This inversion has persisted longer than almost anyone alive has ever experienced. And in terms of depth, it rivals, and in some measures exceeds, the inversions that preceded the greatest financial disasters in history. That alone should make us stop and pay attention. Because when this signal stays active for this long, it has never ended quietly. In the next part, we're going to look backward, not for nostalgia but for patterns. Because history doesn't repeat perfectly. But it rhymes with terrifying accuracy. And the past is already telling us what comes next. The most dangerous thing about financial warnings is not that they're hard to see. It's that they're easy to ignore. Because the signal never arrives during fear. It arrives during confidence. Let's go back to the late 1920s. At the time, the world believed it had entered a new era. Technology was advancing. Productivity was rising. The stock market seemed unstoppable. People were buying stocks on credit. Newspapers talked about permanent prosperity. Risk felt like a thing of the past. And quietly in the background, the yield curve inverted. Short-term interest rates rose above long-term ones. A clear warning that money was tightening and stress was building. But nothing happened. Stocks kept rising. For nearly 2 years. In fact, the market gained close to 50% after the warning appeared. And that delay convinced everyone the signal was wrong. Then came 1929. The market collapsed by nearly 80%. Unemployment surged. An entire generation learned what happens when warnings are dismissed as noise. Fast forward to the late 1990s. Once again, the world was certain it was different this time. The internet had changed everything. Old valuation rules were obsolete. Tech stocks could only go higher. And once again, the yield curve inverted. The signal flashed. The market ignored it. A few months later, the dot-com bubble burst. Trillions in paper wealth vanished almost overnight. Then it happened again. In 2006, this time before the housing crash. The curve inverted, warning that the financial system was under strain. But housing prices kept rising. Stocks pushed to new highs. Unemployment stayed low. People said the same words they always say. This isn't like before. By 2008, the illusion collapsed. Banks failed. Homes were lost. Global markets froze. And once again, that single line on a chart had spoken first. Here's the critical pattern. The yield curve didn't predict panic. It predicted denial. In every case, the market looked strongest right before it broke. The longer the delay between the warning and the collapse, the more severe the damage. And that brings us to today. Because once again, the signal is active. And once again, almost no one is listening. In the next part, we'll talk about why this time may be even more dangerous than all the others, and why the calm we see today may be the most deceptive of all. If this were just another cycle, the risk would already be serious. But this isn't just another cycle. What makes this moment truly dangerous is what the global economy is built on today. Debt. More debt than at any other point in history. In 1929, household debt was relatively small. In 2008, debt was heavily concentrated in housing. But today, debt is everywhere. Mortgages, student loans, auto loans, credit cards, corporate leverage, and massive government deficits that continue to grow. The entire system is powered by borrowed money. That works only as long as borrowing stays cheap. But when interest rates remain high, and stay high, the math begins to fail. And this is where the yield curve becomes critical again. A prolonged inversion means credit conditions are tightening over time. Refinancing becomes more expensive. Rolling over old debt costs more than expected. At first, the impact is invisible. Families keep spending. Businesses keep hiring. Markets stay calm. Because there was a buffer. After the pandemic, consumers were sitting on trillions of dollars in excess savings. Stimulus checks. Deferred spending. Artificial support. That money acted like armor. It absorbed the shock when inflation surged. It softened the blow when rates rose. It delayed the consequences. But that buffer is disappearing. Savings are being drained. Credit cards are reaching their limits. Delinquencies are quietly rising. And once that shield is gone, reality catches up fast. Because debt doesn't disappear. It waits. A household that borrows too much eventually has to stop spending. A business that refinances at double the rate eventually has to cut costs. A government that owes more than it earns has only two choices: print or break. This isn't speculation. It's arithmetic. And the yield curve is showing us the point where that arithmetic stops working. That's why this inversion matters so much. It's not predicting a single event. It's revealing a system under sustained stress, one that has been held together by temporary support and false confidence. And when that support fades, the adjustment is never gentle. In the next part, we'll look at the illusion of strength we see today, and why it has appeared before every major collapse in modern history. One of the most common questions people ask is this: if a crash is coming, why are markets still going up? The answer is simple. That's exactly what always happens. Right before the fall. In 1928, the stock market kept rising for nearly 2 years after the warning appeared. In 2006, stocks reached new highs even as the yield curve inversion deepened. The delay is not a sign of safety. It's a sign of danger. Because the longer nothing happens, the more confident people become. They start to believe the risk is gone. They take on more leverage. They double down. And in doing so, they amplify the very collapse that's waiting ahead. That's the psychological trap. Markets don't crash when fear is high. They crash when confidence is misplaced. Look at the economy today. Headline numbers look strong. Unemployment is low. Markets are celebrating resilience. But beneath the surface, cracks are forming. Corporate bankruptcies are rising. Consumer delinquencies are increasing, quietly, slowly. The cost of financing debt has doubled for many small businesses. And while headlines celebrate job growth, full-time employment is shrinking. More people are working part-time. More people are juggling multiple jobs. It's the same pattern we've seen before. Strength on paper. Weakness underneath. The yield curve doesn't care about optimism. It reflects behavior. And right now, the bond market is acting as if something is coming. While stocks chase hope, bonds are pricing in stress. That divergence never lasts forever. Eventually, reality forces alignment. And when it does, the adjustment is fast, and often violent. In the final part, we'll connect everything together. What this signal is really telling us. Why denial is the greatest risk of all. And how awareness, not panic, is the real advantage. The yield curve is not a prediction. It's a warning. It doesn't tell us the exact day something breaks. It tells us that the system is under pressure, and that pressure is reaching its limit. History is very clear on this. Every major yield curve inversion was followed by a recession. And the deeper the inversion, the more severe the fallout. There has never been a soft landing from an inversion this deep. Never. Yet here we are again telling ourselves familiar stories. That the system is different now. That the data is strong. That technology, innovation, or artificial intelligence will somehow override economic gravity. Every generation has its excuse. In 1929, it was industrial progress. In 2006, it was housing that could never fall. Today it's algorithms and automation. But human behavior hasn't changed. Excess always builds during confidence. Risk is always ignored during calm. And reality always arrives when it's least expected. What comes next may not be just another recession. It could be a deeper reset, the unwinding of years of leverage, excess debt, and false stability. That process is painful. But it's also cleansing. The Great Depression reshaped the financial system. The 2008 crisis transformed global banking. And whatever comes next will do the same. The yield curve is whispering that truth now, long before panic sets in. And the real danger isn't the signal. It's pretending it doesn't exist. So what can we do? Not panic. Not hide. But prepare. Because when the illusion finally breaks, those who understood the signal won't be the ones caught in denial. They'll be the ones standing clear of the wreckage, while everyone else asks how it all happened so fast. If you want to understand the forces shaping markets, money, and history, before they become headlines, this is exactly what we do here. This is Finance Archives. If this analysis helped you see the bigger picture, make sure you're subscribed. New videos go deeper into the signals most people ignore, until it's too late. Leave your thoughts in the comments. And I'll see you in the next archive.